All right, today we are going to crack the code on accounting. And I promise you, it's not about boring spreadsheets or confusing jargon. It's actually a super simple, kind of elegant system that's built on just 3 golden rules. By the end of this, you're going to understand the fundamental language that pretty much every single business on the planet speaks. So let's jump right in.
So first things first, let's talk about the why. Before we get into any rules or systems, you have to understand the basic problem that every business faces, trying to organize what can feel like total and utter financial chaos.
Just imagine a little coffee shop for a second. You've got money coming in for every single latte you sell, right? But at the same time, money is constantly flying out for coffee beans, for rent, for paying your employees. How on earth does the owner know if they're actually building a successful business or if they're just, treading water? Without a system to track it all, it's literally impossible to tell.
Okay, so the most basic building block of this whole system is something called an account. And honestly, the best way to think about an account is just as a series of buckets. That's it. We make one bucket for cash, another one for sales, one for rent, maybe another for the money our customers owe us. Every single time money moves, we just sort it into the right bucket. Simple as that.
Now, having a bunch of different buckets is a great start for sure. But to get real clarity, accountants take all of these little buckets and they group them into just 3 main categories. And this is how we start to see the bigger picture. First up, we've got personal accounts. These are the buckets that track all of your dealings with people or other companies. So think about your suppliers, your customers, even the bank. If a transaction involves an outside person or another business, it's going to fall into a personal account. Next up are real accounts. Now these are for the real, actual, tangible things your business owns. We're talking about the cash in the register, the building you're in, the delivery truck, the computers. A good rule of thumb is, if you can physically reach out and touch it, it's probably a real account. And finally, we have nominal accounts. Now, these are the buckets that really tell you if you're winning or losing the game. All of your income from sales goes in here, but so do all your expenses, like salaries and rent. At the end of the month or the year, these are the accounts that show you the bottom line. So here's a quick recap of how it all fits together. You've got personal accounts for people, real accounts for property and things, and nominal accounts for tracking your performance. Every single transaction, everything from buying a single paper clip to selling the whole company, fits neatly into one of these 3 categories. This super simple sorting method is really the foundation of all financial clarity. Okay, so we've got our buckets and we've sorted them into 3 main types. But how does the money actually move between them? Well, this is where the magic happens. The entire system, the whole thing, is governed by 3 simple, unbreakable golden rules. For personal accounts, remember the ones dealing with people and other companies, the rule is this: debit the receiver, credit the giver. So let's say you pay a supplier. They receive the money, so their account gets debited. We'll get to the other half of that transaction in just a second.
Now for real accounts, your physical stuff. The rule is even more intuitive. It's just debit what comes in, credit what goes out. By the way, debit and credit are just fancy words for the left and right side of a ledger book. And the absolute genius of this system is that for every single debit entry, there has to be an equal and opposite credit entry somewhere else. That's the heart of double-entry bookkeeping, and it's what keeps the whole universe in perfect balance.
And for our last type, the nominal account that track performance, the rule is debit all expenses and losses, credit all incomes and gains. So when you pay a salary, that's an expense, right? So you debit the salary account. When you make a sale, that's income, so you credit your sales account. See how that works?
And here it is. This is how the whole puzzle locks together. Each account type has its own special rule. All you have to do is figure out if you're dealing with a person, a thing, or a performance number, and you instantly know which rule to apply. That's it. This is the entire operating system for business finance right here.
All right, theory is great and all, but let's see how this stuff actually works in the real world with a few quick everyday examples. Okay, example 1. You paid an employee their $1,000 salary in cash. So 2 accounts are affected here. First, there's the salary account, which is a nominal account. Since the salary is an expense, we follow the rule debit all expenses. Easy enough. But at the same time, cash, which is a real account, has just left the business. And the rule for that is credit what goes out. So you've got a debit on one side and a credit on the other. Perfectly balanced.
Let's try another one. You buy a new laptop for $1,500 cash. Again, 2 accounts are involved, but this time they're both real accounts. The laptop came into the business, so we debit what comes in.
and the cash went out of the business, so we credit what goes out. See? Every transaction always has these two sides, making sure the system never goes out of whack.
Okay, one more. A customer pays you $500 in cash. The cash account, which we know is a real account, has increased. So we debit what comes in. Now the customer's account, which is a personal account, was the giver of that cash. So what do? We credit the giver. The rules literally guide every single entry, making sure every transaction is recorded perfectly, every time.
So, we've seen the rules in action. They're simple, they're logical, they're consistent. But let's zoom out for a second. In the grand scheme of things, why is the system that's been around for centuries still so incredibly important today?
Well, because this is so much more than just bookkeeping. This is the universal language of business. Once you get these rules, you can read the financial story of any company on Earth. You can see its health, you can see its strategy, you can see its priorities. It's all right there, just encoded in the numbers. So when you boil it all down, these rules do 4 really powerful things for you. They create a logical system that basically checks itself for errors, because debits always have to equal credits. They give you a crystal clear picture of a company's financial health. They create a universal standard that's understood all over the world. And maybe most importantly, they empower anyone who understands them to make way, way smarter business decisions.